So relevant cost is in terms of whether a cost is relevant for decision making or not is the relevance what we are talking about. So if it gets affected because of a decision, if it can be altered because of decision taking, that would be taken as relevant cost. Otherwise, it is irrelevant in nature. Broadly classifying, we have costs as variable costs and then we have fixed costs. Variable cost is the cost which varies proportionately with the output. Fixed cost is the cost which does not change and which remains um, same. One second, just a minute. The broad classification of costs are variable costs and fixed costs. Then after that, we see that variable cost is a cost which varies proportionately with the output and fixed cost does not change at all within the relevant range. That is until it reaches the maximum capacity, we see the fixed cost does not change. Then out of fixed cost also, we can categorize them as one is avoidable fixed cost or what we also call it as traceable fixed cost, and then we see unavoidable fixed cost. See, this is avoidable fixed cost or we also call it as traceable fixed cost, and then the other category is unavoidable fixed cost. So if we see the costs are taken into consideration like this, the variable cost plus the avoidable fixed cost together become relevant cost. The sum total of the variable cost plus the avoidable fixed cost is the relevant cost. What does it mean? Um, See, when a decision is taken to increase the output, variable cost increases. To decrease the output, variable cost decreases. So, it is the impact of the decision is seen on the cost. So, it is a relevant cost. Then, fixed cost, but basically, we see that no matter what is the level of output which is produced and sold, fixed cost remains the same. So, when fixed cost is the same, any decision which is taken, fixed cost does not get affected. It is the same. Therefore, it is considered as irrelevant. But then again, a part of the fixed cost is considered to be as relevant because sometimes when a decision is taken to cut short or cut down on the output produced or part of the activity is suspended, then we see that a part of the fixed cost can be eliminated. If it can be eliminated, that portion of the fixed cost becomes relevant cost. Like bigger factory premises which was taken on rent basis, now it is required to take only a smaller premises. So the amount of factory rent which can be saved or which can be eliminated becomes relevant cost. Because of the decision taken to cut down on the activity, the amount of fixed cost has reduced. Okay. Only that portion of the fixed cost is relevant. Then unavoidable fixed costs are irrelevant. They are because they would remain the same. Any decision which is taken, This unavoidable fixed cost would remain the same. Therefore, it is absolutely not relevant for decision making. So, what do we have under unavoidable fixed cost? Anything which is unavoidable, or we also call that as committed cost, or we also call it as historical cost. So, historical cost, whatever was already incurred in the past, nothing can be done to undo those costs. We cannot alter them. They are already incurred. Therefore, it is not relevant at the moment for decision making. Then we see that in the past there are certain commitments made to spend these costs. So they also cannot be altered. For example, when asset is purchased, depreciation on the asset would be provided as long as the asset exists. Then we see if the business enters into a lease agreement, as long as the lease period lasts, the um, lease payment has to be paid. Nothing can be done to alter it. Okay, so a level manager does not have the authority to control it, alter it. So it is irrelevant for decision making. So whatever decision the manager takes, there will be no impact on these costs. They would remain the same. Then there are certain notional costs. Notional costs are examples like interest on capital, salary paid to owner. See, in reality, we do not see any such thing happening, but they are allowed to be shown as transactions in the books of accounts. Therefore, they are accounted. But technically, we do not see that a transaction like owner is taking salary from the business or owner is collecting interest on the capital. So those are they are there in the books of account. They are to be entered as expenses in the books of account. So those are notional or imputed costs. Then we see depreciation. Okay, then we also have allocated fixed cost. The common costs which are incurred and which are divided and distributed to various departments in the organization. We call them as allocated fixed costs. So these are to be borne by the department, but nothing can be done to alter it, nothing can be done to eliminate that. So those cannot be eliminated. On the other hand, relevant costs are, we see all variable costs plus the avoidable fixed cost plus the opportunity cost plus out of pocket cost, anything which is related to future cash transactions, related to future and incremental cost. All of them are relevant in nature. So we see variable cost, avoidable fixed cost. Okay. Then opportunity cost, we see opportunity cost. Then we what we call it as out of pocket cost, anything which is spent out of the pockets, that is cash disbursement, cash payments which are made. So out of pocket cost, anything which is relevant for the future cost, incremental cost, any changes which are anticipated and they have to be incorporated. So all of them become part of the relevant cost. Then there are there are common types of decisions. We are going to discuss all of them when the questions arise. So we will see that. And then there are certain other non-financial factors also to be taken into consideration for decision making. How do we decide on whether cost is relevant or not? Relevant cost of material. For example, if we are talking about an example called material. Now, should the material be purchased or is it already there in stock? How does the decision making go? How does the flow charting takes place in terms of what is the next course of action? So, are the materials already in stock? Yes, no. If it is yes, will they be considered for replace? If it is no, they have to be purchased. What is the cost of purchase? Okay, so how much should be spent? So the relevance comes there. That is about incurring the cost. If they have to be replaced, replacement yes, replacement no. If they have to be replaced, what is the replacement cost? If they do not have to be replaced, this material will it be used for other purposes? It goes on like that. So the relevance of it, the relevant decisions about it goes about looking into what are the various alternatives and then how do they proceed further, what is the cost which has to be incurred, or can they use the same material, something like that. It goes on like that. Um, Another example also is given for variable labor and variable overheads. On a similar note, is there spare capacity? Yes. Then no. Can additional labor be hired? What is the cost of labor? If there is spare capacity, they can utilize without incurring any additional cost. Can additional labor be hired? Yes. What is the direct labor cost? No. What is the contribution foregone plus direct labor cost? Um, Sometimes what is done is the the labor who are present there, um, see now it is they do not have any spare capacity. So when they do not have spare capacity, it indicates that they are already operating at 100% capacity. So this is the maximum capacity they are already operating because the decision is about no. In such situation, can additional labor be hired? They do not want to hire the additional labor. So with the existing labor only, they want to take up a new course of action, no new product or new something has wants to be accommodated, but capacity is not available. In that case, what they do is they drop a particular product of few units of a product, or they delay the production or something like that. The existing scenario, they make alterations. So when they make alterations, uh, as a part of that, they would be foregoing the contribution which they can earn on the present scenario. If they drop a particular product, then some capacity will be available. With that capacity, they can take up the production of the new ones, or take up a new activity. So when they are dropping a particular product, they are dropping an activity, some amount of contribution will be foregone. So that foregone contribution becomes their opportunity cost. So that becomes the relevance there. Um, there are certain short-term decisions about special order pricing, accept reject decisions, um, further processing, shutdown, make or buy, or outsourcing. These are and then limiting factors. These are decisions which have to be taken one by one. We will look into all of them and then understand how to take decisions. The first situation here, what we see is special order pricing should be calculated based on relevant costing principles. Okay. The business generally, when they are already producing and selling it to their existing customers, in situations where they want to um, attract new customers, convert them into their regular customers. In such situations, generally what is adopted is they offer the new customers a discounted price. So we see a discounted rate applicable to the new customers. So that is special order pricing. But what is the discount which is offered? That part we have to understand. Should be calculated based on relevant costing principles. What are relevant costing principles? That part let's see. If they are already producing, let's say that this is the capacity level which is available to them from 0 to maximum capacity. But assuming that the present capacity level, let's say that they are at present operating at 60% capacity level. They're producing and also selling the products at 60% capacity level. So when they are already selling them, selling price is equal to, what's the concept of selling price? Selling price is equal to cost price plus profit. So the cost price, whatever is there, will take care of what is cost. Cost is basically the sum total of variable cost plus the fixed cost. The variable cost and the fixed cost added together, we have the total cost. So whatever is the fixed cost which is incurred is already taken care of, and the selling price is decided after absorbing the total fixed cost and the total variable cost incurred till 60% capacity level. So if they start operating beyond 60%, then will their fixed cost increase? No. Fixed cost is the same from 0 till maximum capacity, 100% capacity. It is the same. So no additional fixed cost will be incurred. So whatever is the fixed cost, it's the same from zero number of units till 100% capacity. So because they are already operating at 60% and selling them at 60%, the sales value at 60% is already taking care of the fixed cost. No more additional fixed cost will be incurred until they reach 100% capacity. So beyond this, the spare capacity or the additional capacity, whatever is available, the cost which they would be incurring is only the variable cost. So that makes the firm take a decision on special orders to provide the goods at discounted price. So the cost what will be incurred uh, on the spare capacity for special orders will be only the variable cost. So that is the concept. We will look into the questions. Relevant costing and decision making. The first question, question number 161. Let's see this one and then an organization is considering the cost to be incurred in respect of a special order opportunity. The order would require 1,250 kgs of material D. This is the material that is readily available and regularly used by the organization on its normal products. There are 265 kgs of material D in stock, which cost $795 last week. The current market price is 3.24 per kg. Material D is normally used to make product X. Each unit of product X requires 3 kgs of material D. And if material D is costed at $3 per kg, each unit of X yields a contribution of 15. What is the relevant cost of material D to be included in the costing of the special order? See, they are considering the cost to be incurred in respect of a special order. The order would require 1,250 kgs of material D. The material, this is a material that is readily available and regularly used by the organization on its normal products. Already there are 265 kgs of material D in stock, which cost 795 last week. The current market price is 3.24 per kg. Material D is normally used to make product X. Each unit of X requires 3 kgs of material D. And if material D is costed at 3 per kg, each unit of X yields a contribution of $15. So now we have to decide on what is the relevant cost of material that has to be included in the special order. So now in this situation, they already purchased 265 kgs of material D in stock, which costed 795 last week. So this part of it is historical in nature. They have already purchased that, it's already there. So that is not any cost which is relevant for them. This is historical. Historical costs are irrelevant in nature. So that would not be the case. Then the current market price is 3.24 per kg. So they require 1,250 kgs of material which has to be purchased now. The cash transaction, they have to purchase that. That is relevant for that particular situation, that they should be purchasing it at 3.24 per kg. Okay. Then material D is normally used to make product X. So then each unit of X requires 3 kgs of material D. And if material D is costed at 3 per kg, each unit of X yields a contribution of 15. What are the requirements? How many kgs of material will be required? 3 kgs of material is required to make 1 unit of the product, and it is costed. And if material D is costed at 3 per kg, if it is costing 3 per kg, contribution is 15. But if it is, the situation is considering if it is 3 per kg, right now there is a requirement of 1,250 kgs, and that can be acquired at a price of 3.24. It is not about deciding on what would be the cost or what are the options, what is, that is not the case. At the moment the relevancy is about whether it is a variable or a relevant fixed cost, or it is an opportunity cost, or it is a cash cost, incremental cost. So here they have to at present spend 3.24 to acquire the material. So on that note, what is the relevant cost? So let's present that. We see relevant cost of material is equal to 1,250 kgs of material into the price is 3.24. Check that. So the relevant cost is 4050. H Limited has in stock 15,000 kgs of M, a raw material which is bought for $3 per kg 5 years ago for a product line which was discontinued 4 years ago. At present, M has no use of its existing state but could be sold as scrap for. At present, M has no use in its existing state but could be sold as scrap for one per kg. One of the company's current products, HN, requires 4 kgs of raw material which is available for $5 per kg. M can be modified at a cost of 0.75 per kg so that it may be used as a substitute for this material. However, after modification, 5 kgs of M is required for every unit of HN to be produced. H Limited has now received an invitation to tender for a product which could use M in its present state. What is the relevant cost per kg of M to be included in the cost estimate for the tender? We already have 15,000 kgs of M, a raw material which is bought at 3 per kg 5 years ago, historical in nature. Now, at present, M has no use of its existing state, but could be sold as scrap for 1 per kg. One of company's current products, HN, requires 4 kgs of raw material, which is available at 5 per kg. So, 4 kgs at 5 per kg, $5 per kg is the present cost which they should be spending, because it says that the material M has no use in its existing state, but that would be sold. So, the first paragraph and whatever are the details given are not relevant for us for the moment. Then one of the company's current products requires 4 kgs. So 4 kgs can be acquired at 5 per kg. After that, M can be modified at a cost of 0.75 per kg so that it may be used as a substitute for this material. Used as a substitute for this material. However, after modification, 5 kgs of M is required for every unit of HN to be produced. Okay. H Limited has now received an invitation to tender for a product which could use M in its present state. The M in its present state, it says that M in its present state cannot be used in its present state for this production. So, one of the company's current product, whatever it requires, four has to be acquired at a cost of 5. That is one part of the relevant cost. Then, then. then this material M, 15,000 kgs of M can be considered to be modified at 0.75 per kg. So when it is modified, every single unit would require 5 kgs of material. However, after modification, 5 kgs of M is required for every unit of HN. At present, HN, for the production of HN, new material 4 kgs per unit has to be purchased at a cost of $5 per kg. Later on, already whatever was purchased, it is available. That also can be used, but after modification. But after modification, it will not require only 4 kgs, it would require 5 kgs. So 5 kgs, every kg of material will require a modification cost of 0.75. The requirement is 5 kgs of material. So these are the two relevant costs which are to be included. So what is the relevant cost per kg of M to be included in the cost estimate for the tender? So let's write what is the relevant cost. Question number 162. Hello. Ready. ఏంటి ఉట్టిగా ఏంటి ఉట్టిగానేనా? Okay. Where are we? We see cost of raw material if the material has to be purchased. One situation is purchase 4 kgs of material for every single unit of HN, 4 kgs of material at a cost of 5. So that comes up to be 20. Then we see that already historical cost of 15,000 kgs of material was already acquired at 3 per kg, but because it cannot be used in its present form, so the material either it has to be purchased, or an alternative is also given that M can be modified. So we see another situation, that is M can be modified at a cost of 0.75 per kg so that it may be used as a substitute for this material. So either they go with 20 per kg right now at present, or they can consider the modification part of it. So what is the what is the the difference between these two costs? The relevance part of it comes into a situation where should they spend as much as 0.75 per every 5 kgs of material, which is 3.75, or should they acquire this at 20? So acquiring it at 20 is one material which has to be purchased. Alternate use, see, it has given something, it can be used as a substitute for that material. So this is a M can be modified at a cost of 0.75 per kg so that it may be used as a substitute for this material. Substitute for this material. So that cost, when we calculate, it comes out to be as 3.75. They are asked to prepare a tender. H Limited has now received an invitation to tender for a product which could use M in its present state. So the material M, whatever they have, 15,000 kgs, they have received it an invitation to present a tender. So what can be the price which they can quote? Invitation to tender for a product which could use M in its present state. What is the relevant cost per kg of M to be included in the cost estimate for the tender? So um, the price what they can quote here for the tender would be 3.25 per kg. See, they can present the tender for each unit of M, which can be used in its present format. So that can be presented at a cost of 16.25. See, if they purchase it, if they purchase the material for production of HN, they will have to incur $20 per unit of HN. And one substitute what they can use by spending it is 3.75 per unit of HN, because the material is already present there. That is already there with them. The material is already there. They just have to spend 3.75. So the production of HN will take care of these two things. Fine. So the opportunity cost, now either they go with the use of this material M, or acquire the material from outside. So when they compare these two aspects, there is an opportunity cost of 16.25. So if they are presenting a quotation tender to outsiders, their opportunity cost is to the extent of 16.25. So per unit of material M, which they can quote is 3.25 per kg of material. So that is the price what they can quote to outsiders. H Limited has now received an invitation to tender for the product which could use M. So if it can use M, um, what price should be quoted? So the raw material, the main raw material which they are purchasing at 20, okay, then the material M which is already present there, the modification charges which are included, so that is not as of now incurred. The cost is not incurred. Only the modification costs are incurred now. So only the modification part of it will be incurred. So the choice is between 20 or 3.75. So the cost of foregoing the next best alternative, we see that what is the regret? Regret would be to the extent of 16.25. So that divided by 5 kgs is 3.25. So they can present a quotation to the extent of 3.25. That's the opportunity cost which is present there. 163 UU company has been asked to quote for a special contract which will require material X. The following information is available on material X: book value, scrap value, replacement cost. Um, the special contract would require 10 kgs of material X. There are 250 kgs of this material in stock which was purchased in error over 2 years ago. It has just been noticed that if material X is modified at a cost of 2 per kg, it could then be used as a substitute for material Y, which is in regular use and currently costs $6 per kg. The relevant cost of the material for the special contract is book value is 5, scrap value is 0.5 per kg, replacement cost is 5.5. Special contract would require 10 kgs of material. There are 250 kgs of material in stock which was purchased in error over 2 years ago. It has just been noticed that if material X is modified at a cost of 2 per kg. So modification charges are 2 per kg. It could then be used as a substitute for material which is in regular use and currently costs 6. So like the previous question, the current cost of material is 6. Modification charges are 2. So 6 minus 2, 4 will become the opportunity cost. That is used, that should be used for the special contract. Special contract will require material of 10 kgs. So 10 kgs applied at 6 minus 2. So let's write current cost of material. Current cost of material is 6. After that, we see modification cost is this is 4. So the opportunity cost which is equal, I'm sorry, this is 2. So the special contract requires how many kgs? So relevant cost 10 kgs into 4 is equal to $40. One 164, a company has been asked to quote for a special contract. The following information is available on the labor required for the contract. The special contract would require 100 hours of labor. However, the laborers who are each paid $15 per hour are working at full capacity. There is a shortage of labor in the market, and therefore the labor required to undertake this special contract would have to be taken from another contract Z, which currently utilizes 500 hours of labor and generates 5,000 worth of contribution. If the labor was taken from contract Z, then the whole of contract Z would have to be delayed, and such delay would invoke a penalty fee of 1,000. What's the relevant cost of labor? Special contract would require 100 hours of labor. However, the laborers who are each paid $50 per hour are already working at full capacity. So they are operating at 100% capacity. So can they accommodate a special contract? It is not possible to accommodate because they are already operating at full capacity. So now there is a shortage of labor in the market, and therefore, so they cannot extend beyond their 100% capacity because there is shortage of labor. So in such situation, and therefore the labor required to undertake this special contract would have to be taken from another contract Z. And Z, which currently utilizes 500 hours of labor and generates 5,000 worth of contribution. If the labor was taken from contract Z, then the whole of contract Z would have to be delayed, and that will cost them a penalty of 1,000. So if they delay the present things, if they are thinking about taking this labor from another contract Z. So contract Z will not be completed on time. So when it is not completed on time, then what happens? They would forego something, plus they will, of course they will get back their contribution all. See, contribution of 5,000 can be earned from contract Z, but um, right now they would not get. Plus um, they the delay in completing contract Z is attracting a penalty of 1,000. So they that is a loss for them. So this 1,000 loss also should be charged to the other party. So the special contract, as of now, special contract would require 100 hours of labor, and each are paid at the rate of 15 per hour. So that's the cost which they have to spend. That's the minimum cost which they have to spend. But if things were all fine, if there was spare capacity available, so they can spend only 100 hours at the rate of 15 per hour is the cost of labor. They can charge the same price as low as the variable cost they can charge. Okay, because this is to attract them to become regular customers. So you also see that whenever you are trying a new product, first time users are given huge discounts. You also must have observed that. But the same price is not applicable eventually. So every other time when you purchase, you will be paying the regular price. But the first time they attract with prices as low as how much ever is their variable cost. Here also the variable cost about labor is 100 hours into each at the rate of 15. So that could be the least price which can be charged on the special orders. But by accommodating the special order, they will have to delay their present contract Z. So by delaying it, they are they would be charged with a penalty of 1,000. So why should they forego that part of it? So that also will be charged to the new customer. So the relevant cost would be, there are two aspects of it. Question number 164. Hundred hours will be calculated at the rate of 15. So that's the minimum amount of variable cost. Now they also now have to pay a penalty. So that why would they pay? They will charge this. Okay, they have to pay. So they will recover it from the special order. So plus 1,000 is their fine penalty. So that would be the relevant cost. So 2,500 is the relevant cost. A company is preparing a quotation for a 1-month consultancy project. Currently, the company employs a consultant on an annual salary of 36,000. The consultant is fully employed on current projects, and if she were to be transferred to this new project, then an existing junior consultant would be used to cover her current work. The junior consultant would be paid a bonus of 5,000 for undertaking this additional responsibility. Alternatively, the company could hire an external consultant on a 1-month contract at a cost of 4,500. The relevant cost to be used in preparing the quotation is, so this situation is, the company employs a consultant on an annual salary of 36,000. This consultant is fully employed on current projects, and if she were to be transferred to this new project, then an existing junior consultant would be used to cover her current work. The junior consultant would be paid a bonus of 5,000. So in her place, another junior consultant um, can be used to take up the work, whatever this consultant is working on. So the junior consultant will be paid additional 5,000 bonus. So that is the situation. 5,000. Technically, this will be the cost, because now the consultant, if she were to be transferred to the new project, the present work, whatever is being done by the consultant, will be taken over by a junior consultant. Junior consultant, it says that it is not that his salary only will cover that additional work. He would be paid a bonus. Bonus is in addition. So additional amount which is paid to the junior consultant is 5,000. So if it is additional amount which is paid, so that becomes cost for the company. Alternatively, the company could hire an external consultant, and this would cost the company 4,500. So the choice is between um, assigning the work to the junior consultant, or hiring an external consultant. So what is better? Whichever is cost effective, that will be taken up. So bonus paid to the junior consultant is one set of cost which is equal to 5,000. Or we see um, cost paid to external consultant is equal to 4,500. So what's the relevance? Which one is relevant? Which one is cost effective? That would become the relevant cost. So relevant cost is equal to 4,500. So that is cheaper. Jones Company is bidding for a contract which is due to be started within a few days. The contract will use up its stock of material X5, which will otherwise be held for 1 month. In 1 month's time, there is a probability of 0.6 that it will be used. If it is not used, then the material will be sold. Estimates are as follows. Replacement cost of stock in 1 month's time is 15,000. Sales value in 1 month's time is 12,000. Stock holding cost for 1 month is 900. The expected relevant cost of material X5 for use when evaluating the viability of the contract is how much? Did you learn any time expected value concept? Because the probabilities are given as 0.6. If the in 1 month's time there is a probability of 0.6 that it will be used. When will it be used? Did you learn any time what is expected value concept? Please respond. Did you learn expected value concept at any given point of time? Huh. Okay. So let's take it up. If you know what is expected value, Jones Company is bidding for a contract which is due to be started within a few days. The contract will use up its stock of material XY, which will otherwise be held for 1 month. So, if okay, the other details are in 1 month's time, there is a chance that they can use this material. The probability of using this is 0.6 that it will be used. If it is not used, then the material will be sold. Estimates are as follows. Replacement cost of stock in 1 month's time is 15,000. Sales value in 1 month's time is 12,000. Uh, See, for 1 month, I mean, in any case, 1 month the material will be there. So 1 month time, the cost of material is cost of holding the material. Holding costs are storage costs. They have to store. So any situation which is considered either to replace cost of stock in 1 month time, or it can be sold, sale value. Either it could be used, replaced, or it will be sold. So two situations are there, but anything will happen only after 1 month. So for 1 month, they will have to incur a cost of holding the material for 900. So holding cost is storage cost. 900 has to be incurred. So we see there are two different situations which are present. So the situations are about the replacement, or they can be sold if it is not used. So if it is used, it would be replacement is one option. The second option is sale. Anything can happen. So but that anything would happen only after 1 month. So what are the cash flows? The cash flows are mentioned, and also we have the probabilities mentioned. So the cash flow is 15,000. Then if it is sold, it is 12,000. The probability that it will be used, so that will be that is given as 0.6. So if it is not used, it would be sold. So the only two alternatives are there. First alternative, if it has 0.6, the other alternative will definitely have 40%. So altogether it is 1. So the expected value, what is the expected value? So when we calculate, expected value is equal to the product of these two. Okay, so then this is the total expected value. The expected relevant cost of material. So expected relevant cost of material would be otherwise, if things were to be done immediately, it is 13,800, but this would happen 1 month later. So for 1 month they will have to store the material. Then for storing the material, they will have to spend a cost, so 12,900 becomes their relevant cost. Question number 167. In order to utilize some spare capacity, K Limited is preparing a quotation for a special order which requires 2000 kgs of material J. K Limited has 800 kgs of material J in stock. Original cost is 7 per kg. Material J is used in the company's main product L. Each unit of L uses 5 kgs of material J, and based on an input value of $7 per kg of J, each unit of L yields a contribution of 10. The resale value of material J is 5.50 per kg. The present replacement price of material J is $8 per kg. Material J is readily available in the market. The relevant cost of 2000 kgs of material J to be included in the quotation is. Each unit of L uses 5 kgs of material, and based on an input value of 7 per kg of J, each unit of L yields a contribution of 10. Okay, this is usage of material, 5 kgs of material J. Based on an input value of $7 per kg of J, each unit of L. Okay. The question is about what is the relevant cost of material J. This is about L. L yields a contribution of 10. So that will not be useful here, which we have to take. The resale value of material J is 5.50. The present replacement price of material J is 8 per kg. Material J is readily available in the market. Present replacement cost. Okay, so after the material is purchased, the resale value of material J is 5.50. But so they require 2000 kgs of material J. K Limited has 800 kgs of material J in stock. The cost was 7 per kg. Material J is used in the company's main product. So 800 kgs of material which was already purchased at a cost of 7 is historical nature. So that is not, as of now, that's the sunk cost. As of now, that is not relevant for decision making. Then the usage of material in the manufacturing of L and what L does and what contribution L is would generate, all that is for the moment it is irrelevant, not useful for us. Then after the material is purchased, the material can have a resale value at 5.50. That is also not the present criteria. The present criteria is now the present replacement price of material J is $8 per kg. So that is the only thing which is important now. So the relevant cost of 2000 kgs of material J to be included in the quotation will be at a cost of $8 per kg. Okay. So let's write. 2000 kgs into 8, which is equal to 160. No, 16,000. 2, no? $16,000. 16,000. There are many questions on relevant costing. Of course, every topic there are many questions. Um, the question says a company is calculating the relevant cost of material to be used on a particular contract. The contract requires 4,200 kgs of material H, and this can be bought for 6.30 per kg. The company bought 10,000 kgs of material H some time ago when it paid 4.50 per kg. Currently, 3,700 kgs of this remains in stock. The stock of material H could be sold for 3.20 per kg. The company has no other use for material H other than on this contract, but it could modify it at a cost of 3.70 per kg and use it as a substitute for material J. Material J is regularly used by the company and can be bought for 7.50 per kg. The relevant cost of the material for the contract is. Before we proceed, I asked one of you to give your mail ID, so that I can send the recordings. See, the other college students also are asking for me to send their college recordings. So, since there was some um, in between classes were not attended by you, or some disturbance was there. So, you don't have all the questions for which the solutions are done in the class. So, I will share those recordings. I asked you to give me a mail ID. Did any one of you share it with me? If you want those recordings, please give me one mail ID before I forget. Because tonight I will be sending the. So in that only I will send. Let me write the. Because I have to. We cannot copy it from the chat box. So we have to type. I've typed it here so that it will be there. HISHAMMOHD. Double ASHRAFT at gmail.com. Okay, done. Question number 169. So the company has no other use of material H. So we are asked to find out what is the relevant cost of material for this particular contract. Material J is regularly used by the company and then bought for 7.50. the contract requires 4,200 kgs of material, and this can be bought for 6.30 per kg. Okay, they already have purchased 10,000 kgs of material, out of which 3,700 kgs of material are available. Then this can be used on this contract. There is no other use, but this can be used on this contract. But it could modify it at a cost of 3.70 per kg. So and use it as a use it as a substitute for material J. Material J is regularly used by the company and can be bought for 7.5. Purchase cost of material J is 7.50, but the modification costs are 3.70. So what is the relevant part of it? So relevant cost has to be considered. Um, but availability is only 3,700. Total requirement of material. We see that 3,700 kgs are already available with them. Stock in on hand. Stock on hand is equal to, we see that 3,700 kgs of material is already available. So the rest of it has to be acquired. So stock to be purchased is equal to additional 500 kgs will have to be purchased. Done. Now coming to the stock which is there available on hand. So the current market price of this material J, which is already available with them, that material, see, the company bought 10,000 kgs of material H. So out of H, 3,700 is available. This 3,700 kgs of material H can be used as can be used here for the production. So in place of material H, um, the company has no other use for material H other than on this contract, but it could modify it at a cost of 3.70 per kg and use it as a substitute for material J. That material J at present costs 7.50. So market price of J. So J and HR can be used as substitute. So whatever is the price, if H was not available, they would have purchased J, and J is available at a cost of 7.50. So purchase price of J, purchase price of J is equal to, we see 7.50. Then we also have modification cost. Modification cost is at the rate of 3.70. So what is the opportunity cost or the relevant cost? Relevant cost for them is the difference between these two. 7.5 minus 3.7, 3.8. So the total relevant cost of all the material. So relevant total material is equal to, there are two sets of material. One is 3,700. The cost which is applicable on that is 3.8. Plus now they have to purchase additional 500 kgs. This material can be purchased at a price of 6.30. We can see the contract requires 4,200 kgs of material hedge, and this can be bought for 6.30. So we multiply 500 into 6.30. So check how much is that. Okay, 17,210. Now we are moving to a different decision. Question number 170. A company manufactures two joint products and a byproduct in a single process, which are all sold as soon as they are output from the process without further processing. Joint costs are shared on the basis of sales value at the split off point, and the revenue from the byproduct is credited to the cost of the production. The budget of the next period is as follows. We have certain details, but let's first see what are joint products. Now, sometimes when the production process is the same, initially it is the same for more than one product. So all these products go through the same production process. Um, till they get separated. So they pass through the same production process. Let's say that two products are there. So if the products, both the products are initially they require the same process, so they pass through the same process until a particular point of time. So the initial process is the same, and the cost which is incurred also would be combinedly incurred. Then comes a point where they get separated. So the separation point we call it as split off point. So the separation point is called as split off point. They get split into their separate or individual products. So as many number of products which they produce, they get separated into that. So after they get separated, till now whatever costs which are incurred are jointly incurred. So they are called as joint cost. Then after they get separated, they then we call them as after further processing cost, or uh, after separation cost. So either ways we can cost. Without further processing, it says that the processing is required. See, individually they get separated, then their respective process would be there. So that process will require some cost. So after they get separated, after separation cost or separable cost or further processing cost, whatever are that we call it as. These are separable costs. Okay. Then in this kind of a process, sometimes when the intention is to produce the main products, some joint products, because of the production process, some more products also can be produced which do not have the value as much as the main products. Some minimum value it would be there. So that is called as a byproduct. Okay. Now the relevant costing situations, we have one decision about joint products is there included. So just see this one. Until the separation, we all the costs whatever are incurred are called as joint cost. There is a point of separation which is called as split off point. After split off point, the cost gets separated, so they are also called as further processing cost or after separation cost. So one second we'll just visit the um, PPT. Okay, further processing. So should they take up the further processing or not is the case. So the decision. So under relevant costing, till now we have done special order pricing. After that, this is this is the situation further processing. So we have to take up this further processing. Further processing. What is that basically they are talking about? Let's get back to the question and then there only we'll discuss. See, when they get separated, see, there is a process which is required. Costs are jointly incurred. So joint cost, there is a split off point. So sometimes when at the split off point, so split off point, the products may be in intermediary stage. They may not be completely processed. See, even sometimes when we see that there are semi-finished form also, or they are called as intermediary products also, they still have a market. So the decision here is about should they sell, if at all, if there is a selling price available at a sale value available at split off point, should they consider selling it at the split off point or wait until the final processing is done? So the after separation costs are also incurred, the separation costs are incurred, and then sell that. So it's a decision between selling at the split off point or after separation at this point. So that's the decision. Now, how do we decide on that? Until the split off point, all of them required joint cost to be incurred. So there is nothing, separate about that. All the products have to go through that. So it is not relevant for decision making. The relevance for the decision making depends on should they sell it at the split off point or should they process it further. Okay, that's the decision. So how do we decide on the decision criteria? I'm just telling you the decision criteria. So there is a sale value. So there is a sale value. Now sale value we can see at the split off point, that is one level at the split off point, and then we also see there is a sale value after further processing. There are two different sale values which are present. So definitely at the split off point, the value would be much lesser than what the value is there after final finished product is produced. So there would be a difference in the selling price. So the difference in the selling price is the incremental benefit. This is one benefit, first benefit. If they do not want this and then take up the further processing, add some more cost and then sell it, definitely the benefit would be higher. So here we see that there is an incremental benefit if they wait until it is further processed. But how does it happen? It will happen only when they spend separation cost, after separation cost. So after separation cost is the incremental cost. Incremental cost is equal to after separation because they got separated. To make it as a finished product, they have to incur this after separation cost. So this is the incremental cost. So if we put it as this is if it is separation cost is nothing but incremental cost. So we have to compare whether incremental benefit is more than incremental cost or incremental cost is more than incremental benefit. If the benefit is more, process it further. If the benefit is less, sell it at the split off point. That is the decision criteria. I hope I am clear. So now in this particular situation, a company manufactures two joint products and a byproduct. Byproducts are not always intentional to be produced. Because of the production process, that comes out as some product which can be sold. Okay, which are all sold as soon as they are output from the process. So all of them have a market value as soon as they are out from the process without further processing, which means that all the three products, so there are two joint products and one byproduct, all three products have a value at the split of it as soon as they are out of the process without further processing. So at the split of point, there is a sale value. Then joint costs are shared on the basis of the sale value and the split of point. And the revenue from the byproduct is credited to the cost of production. The budget for the next period is as follows. Processing cost. Processing cost is 45,000. Then output in units is X, Y, Z. The output is given. Sale prices are given as 80 for X, 100 for Y, and 0.20 for Z. The question is not about whether to sell it at the split of point or further process it. The question is about how do we allocate the cost. See, the question says joint costs. Joint costs are shared on the basis of the sale value at the split of point and the revenue from the byproduct that I will explain. From the byproduct is credited to the cost of production. What is the joint cost? Let's check that joint cost is 45,000. Do you see that? So this has to be allocated to all the products. That's the point there. But first, this cost will be allocated based on the sale value at the split off point. Let's check what is the sale value at the split off point. Question number 170. So we see products X, then Y, then Z. So what is sale value? Each unit can be sold at 80, then this is 100, then this is 0.20. Units are given as 250, then we have 400, then we have 3000. So sales, let's put it as selling price. Sale value will be okay. Z is a byproduct. See, Z does not stand on par with the main product. It's just a byproduct. So when it is a byproduct, the treatment of byproduct is it is some value which is just realized. So when we compare the values, X sale value is 20,000, Y sale value is 40,000, but whereas Z sale value is only 600. Do you see that? So it doesn't stand on par with the main products. It is just a byproduct. So the treatment of this would be like the treatment of scrap. Sometimes when material gets damaged, the material is sold for some minimum value. In cost sheet, you must be remembering the works overhead or the factory overheads. We make an adjustment of scrap from the works cost less sale of scraps. Scrap value is it is not revenue generated, it is just an adjustment of the cost. I hope you remember that logic. Same is the case we applied here also. So the joint cost or the processing cost incurred are 45,000. From 45,000 less sale value of byproduct. that is 600. So, though they have incurred 45,600 can be realized from sale of scrap value. So, the amount of joint cost which has to be allocated to X and Y is 44,400. Okay, so they have to be allocated to X and Y. What is the basis? The basis is based on the sale value at the split of point, which is 20,000 and 40,000. Do you see that 20,000 and 40,000? So that is 1 is to 2. So let's allocate the cost. In the ratio of 1 is to 2, because it is 20,000 is to 40,000, so ratio will be 1 is to 2. Done. I'm writing it here, otherwise we'll bring it down and then we'll have it here, because the product joint cost allocated. X will get 44,400 into 1 by 3, and Y will get 44,400 into 2 by 3. Okay, it's not just the cost allocated, it is cost per unit. So cost per unit is equal to, we have joint cost allocated divided by the number of units. 59.2 for X and 74 for Y. We have class tomorrow also, no? Or no class? Tomorrow is Saturday. Is there a class on Saturday? Let me just check that and then here in May. What is tomorrow's date? 15th. Okay, Monday is next. Yeah, no class on Saturday. That's right. Monday is next, and is that the last class? No. Monday we have, Tuesday also we have a class. Then Wednesday. we have another three classes, 19th. So another three classes after today. Done. Uh, Question number 171. Let's see, only 10 minutes time is there. P Limited is considering whether to continue making a component or buy it from an uh, outside supplier. It uses 12,000 of the components each year. The internal manufacturing cost comprises these are the costs. Then, if the direct labor were not used to manufacture the component, it would be used to increase the production of another item for which there is unlimited demand. This other item has a contribution of 10 per unit but requires $8 of labor per unit. The maximum price per component at which buying is preferable to internal manufacture is. See, this is make or buy decision. So, the next one, what we have is make or buy. So, that is one situation. What is make or buy? Make or buy, this one decision. What is this decision basically? See, when the products are manufactured, the manufactured products are in certain cases we see they are basically um, many components are assembled to make the final product. For example, the wristwatch what you wear has if for example if it is a leather watch which one is wearing, so there is a watch main motor, the engine or whatever motor or whatever that mechanism. Then there's a glass frame, there is a leather belt, there is a steel buckle. There are many things. Steel handles are there. Sometimes stones are placed in that. Um, then, for example, a motorbike is there. Motorbike is manufactured. The main motor, the main engine of the motorbike is one thing. Then there are many components like seat has to be leather seat. Then there are rubber for the handles and all rubber is used. Mirrors are there, steel rods are there. Um, there vary various components which are assembled together so that one final product is produced. Okay, see the product whatever is the main product that is their expertise. See, if somebody watch manufacturer will have his expertise in making the watch watch motor, that part he has his expertise in that. He would not have his expertise in designing the leather belt, cutting the leather belt and making it into the required shape. Okay, so then what he has to do? He has to purchase an equipment to make or cut the leather into the required shape and all, which is not his expertise. And uh, then what can he do is he can approach someone, a leather manufacturer or expert in providing leather products. For them, they have the equipment because their core competency is in terms of making leather components. So then in such situation, they will have a better hold. For them, cost per unit also will be less because they are producing it at large scale. They are into that, so they might have achieved economies of scale, so it is reasonable for them. But for this person who is making the watches, he has to now purchase an equipment. The cost of equipment, when will it will recover? It takes a longer period of time. But somebody who's an expert in that particular field will have it available at a cheaper rate. So the decisions about um, to making the component it's not about the final product, it is about only about the component. Making the component or buying it from outside supplier, so that is a decision which has to be taken. whether to make it or buy it from an outside supplier. To make the component, what are the costs which are required? The costs which are required are the variable cost and the fixed cost. Of course, there's another opportunity cost. If it is not in this problem, some other problem I will explain. For the moment, let's put it simple. What are the costs of buying? Buying the component. So whatever is the price which the supplier offers, that price, supplier's price, it's the cost. Just because they are not making one component, can they eliminate the fixed cost? Fixed cost will be incurred as it is. There will be no change in fixed cost. Just because one component is not made, can they avoid fixed cost? They cannot. So now we see that there is one cost which is fixed in nature. There is no impact on of the decision on fixed cost. So now we see that fixed cost is irrelevant. What is relevant? The variable cost of making and the supplier's price if it is bought from the supplier. So the decision would be between what is the variable cost of making and what is the price the supplier is offering if it is purchased from him. Whichever is cheaper, the decision would be for that, either to make it or to buy it. Whichever price is cheaper, we go with that particular decision. So we see a set of variable costs and fixed costs. So variable costs are a component of three items, isn't it? Direct material, direct labor, and variable overhead. Then supplier is charging a price. It's the direct labor. There is one more adjustment here. If the direct labor were not used to manufacture the component, it would be used to increase the production of another item for which there is unlimited demand. This other item has a contribution of 10 per unit but requires $8 per $8 of labor per unit. Okay, so $8 of labor per unit when it is used, it can give a contribution of $10 per unit. So this is one adjustment which is given. The question is asking about what is the maximum price per component at which the buying is preferable to internal manufacture. So the decision should be about the relevant cost versus the supplier's price. But here only we have the opportunity cost also. So there is a variable cost of 3 plus 4 plus 1. 7 is the variable cost. Then what are the other two items? There is one specific fixed cost. There is one other fixed cost. So there are two more items. Specific fixed cost is only, this fixed cost is very specific to manufacturing of this component. So it is not only till here, but it is also extending to this part of it. So like we have discussed about what are the relevant costs is all the variable cost plus the avoidable fixed cost or traceable fixed cost. If it is traced with a particular product, that becomes a traceable fixed cost. So 7 is that, plus we see that there is one specific fixed cost, so that is 2. So we have variable cost plus the specific fixed cost, or I will write it as relevant fixed cost. Is it only this part of it which has to be considered? It says that if they don't make, the product, they can use this direct labor. Direct labor can be used, and some more contribution can be earned. Okay, if they do not manufacture, If they do not manufacture, the direct labor cost or direct labor whatever is used right now for manufacturing can be used for some other product, and that contribution can be earned. But when they are making, can they earn the contribution? They cannot earn the contribution. So they are foregoing that contribution, isn't it? Now they are making. So we are discussing about making. When they make, can they earn this contribution? They cannot earn the contribution, isn't it? They cannot earn the contribution. So when they cannot earn the contribution, so it would be the opportunity cost. So the decision is simply not between variable and supplier's price, but variable cost plus the relevant fixed cost plus the opportunity cost. All of them versus supplier's price. Variable cost, relevant fixed cost plus the opportunity cost is the cost of making that versus the supplier's price. So whichever is cheaper, we go with that. But the question here is, what is the maximum price which can be offered um, at which buying is preferable to internal manufacture? So maximum is so at a point where both of them are equal. That is what is basically their intention is. So question number 171. Quickly write the solution. If it is needed, I'll explain it on Monday again. So let's put it as what is variable cost. Variable cost, we have three items, which is 3 plus 4 plus 1. So we have it as 7, no, 8. 3 plus 4. I'm really sorry, this is not 7, this is 8. I didn't realize it. It is 8. Then we have specific fixed cost. Specific fixed cost is given as 2.5. Then we have opportunity cost. What are the terms of opportunity cost? When labor of $8 is used, contribution of 10 can be earned. But as of now, how much labor cost are they using? Only 4, half of it. So contribution also will be half of it only. Do you see that? When they use 8 labor, contribution is 10. If they use 4 labor, contribution will be only half of that. So I'm just writing the solution here. Again, I will explain it on already so much time happened. So this, so the price add it up. We have it as 15.5. So the price, the maximum price what supplier can offer is 15.5. Anything less than 15.5, they would buy. But at least if it is 15.5, that's the maximum. Beyond that, it is not worth buying it from the supplier. So if the maximum price what is offered by the supplier is 15.5, they can go ahead buying the component. I hope it is clear. So let's end the class here and then we'll meet again on Monday. Right? Good day. And Isham, happy Eid.